Chapter 1: The Gateway to the Canadian Financial Industry. The Canadian financial landscape is a vast, interconnected ecosystem that serves as the lifeblood of the nation's economy. From the towering glass monoliths of Bay Street to the boutique advisory firms nestled in the Rockies, this industry facilitates the flow of trillions of dollars, bridging the gap between those with capital to invest and those in need of funds to innovate and grow. For the uninitiated, this world can seem like an impenetrable fortress of acronyms, complex regulations, and volatile market charts. However, beneath the surface lies a structured framework governed by rigorous standards and a collective commitment to maintaining the integrity of the capital markets. Standing at the threshold of this world is the Canadian Securities Course, CSC. Often referred to as the gold standard for entry-level finance, it is more than just a certification. It is the industry's universal language. Whether your sights are set on becoming a full-service investment advisor, a retail banker, a portfolio manager, or a compliance officer, the CSC serves as the foundational credential that proves you possess the technical literacy required to navigate the complexities of securities, taxation, and economic theory. It is the baseline requirement that transforms an aspiring professional into a credible participant in the national marketplace. The significance of the CSC extends far beyond a simple line item on a resume. In a profession built entirely on the bedrock of trust, the designation signals to employers and clients alike that you have mastered the regulatory environment and ethical standards necessary to protect the public interest. The Canadian investment industry is one of the most respected in the world, known for its stability and prudent oversight. By embarking on this journey, you are not just studying for an exam, you are gaining the keys to the gateway of a high-stakes, high-reward career, ensuring you have the strategic insight to help Canadians achieve their financial dreams while upholding the prestige of the industry itself. Chapter 2: The Regulatory Environment and Market Oversight. The Canadian financial landscape is often described as a vast, interconnected machine, but without a rigorous system of cogs and governors, the friction of self-interest would quickly lead to a breakdown. At the heart of this machine lies the regulatory environment, a sophisticated web of provincial authorities and self-regulatory organizations, SROs, designed to maintain the delicate balance between market efficiency and investor protection. To the uninitiated, the alphabet soup of acronyms like CIRO, the CSA, and various provincial commissions may seem daunting, yet they form the essential rules of the road that ensure every participant, from the retail investor to the institutional heavyweight, plays by the same set of ethical and legal standards. Understanding this framework begins with the recognition that Canada does not have a single federal securities regulator. Instead, the power resides with the provinces and territories, which coordinate their efforts through the Canadian Securities Administrators, CSA. This decentralized approach is unique among global financial hubs, requiring a passport system that allows market participants to operate across borders while adhering to a harmonized set of rules. For the CSC candidate, grasping how these provincial bodies delegate authority to organizations like the Canadian Investment Regulatory Organization, the newly unified successor to IIROC and the MFDA, is crucial. These entities serve as the front line of defense, setting the high-water marks for professional conduct, capital adequacy, and market integrity. Beyond the administrative structure, the regulatory environment is defined by its commitment to three core pillars: protecting investors from unfair or fraudulent practices, ensuring markets are fair and efficient, and reducing systemic risk. This is achieved through a rigorous regime of disclosure and registration. Whether it is a firm ensuring it has enough capital to weather a market downturn or an individual advisor adhering to the Know Your Client (KYC) rule, the overarching goal remains the same: transparency. By pulling back the curtain on these legal requirements, we see that regulation is not merely a hurdle for advisors to clear, but the very foundation upon which public trust in the Canadian financial system is built. Chapter 3: Ethics, Conduct, and the Advisor-Client Relationship. Trust is the invisible currency of the financial world, yet it is the most valuable asset any advisor will ever hold. While the technical mechanics of equities and fixed income securities provide the foundation for growth, The ethical framework governs whether that growth is sustainable or built on shifting sands. In the Canadian securities industry, integrity is not merely a suggestion, it is a codified requirement. As an advisor, you are not simply a salesperson, but a gatekeeper of your client's financial futures, tasked with navigating the delicate balance between market opportunity and institutional responsibility. At the heart of this responsibility lies the Know Your Client, KYC, rule, a cornerstone of Canadian securities regulation that serves as both a shield for the investor and a guide for the advisor. KYC is far more than a checklist of administrative hurdles. It is an investigative process designed to uncover the nuances of a client's financial life. To truly know a client, you must look beyond their bank balance to understand their risk tolerance, investment knowledge, time horizon, and ultimate objectives. This deeper understanding ensures that every recommendation made and every trade executed is genuinely suitable, protecting the client from undue risk and the advisor from professional liability. To formalize this relationship, the industry relies on the Relationship Disclosure Document, RDD, a vital tool that bridges the gap between client expectations and advisor obligations. This document acts as a roadmap for the professional partnership, explicitly detailing the services to be provided, the fees to be charged, and the methods used to assess suitability. By laying these cards on the table from day one, you establish a transparent environment where conflict of interest is minimized and accountability is prioritized. In an industry governed by strict compliance, mastering these ethical standards is what distinguishes a mere employee from a true professional who commands the long-term respect of their peers and clientele. Chapter 4: Economics and the Investment Environment. The machinery of the capital markets does not turn in a vacuum. It is fueled by the relentless push and pull of economic forces that dictate everything from the price of a local cup of coffee to the yield on a federal bond. To master the Canadian Securities Course, one must first view the world through the lens of scarcity and choice. At its most fundamental level, the market is a grand negotiation defined by supply and demand. In a Canadian context, this might manifest as the fluctuating price of Western Canadian Select Oil or the heated bidding wars in the Toronto real estate market. When demand outstrips supply, prices climb, signaling to producers to increase output. When the reverse occurs, the surplus forces a correction. Understanding these microeconomic triggers is the first step in predicting how individual companies and sectors will perform. However, an investor must also zoom out to capture the macroeconomic landscape, the big picture, that defines the Canadian investment environment. This involves tracking the rhythmic expansion and contraction of the business cycle. We measure the pulse of the nation through gross domestic product, GDP, but we feel its health through the twin pressures of inflation and unemployment. For a Canadian investor, inflation is the silent erosion of purchasing power, a force that the Bank of Canada seeks to tame through the strategic manipulation of the overnight rate. When the Consumer Price Index, CPI, begins to heat up, the central bank exerts upward pressure on interest rates, a move that ripple effects through the economy, cooling consumer spending and revaluing fixed income securities almost instantly. The interplay between these variables, interest rates, inflation, and employment, serves as the primary driver for market movements. A falling unemployment rate is generally a sign of a robust economy, but if it drops too low, it can lead to wage-push inflation, prompting a hawkish turn from policymakers. As you navigate this chapter, think of yourself as an economic detective. You are not just memorizing definitions. You are learning to read the signals that tell you where the economy is headed. By understanding how fiscal policy from Ottawa and monetary policy from the Bank of Canada interact, you gain the foresight to anticipate market shifts before they are reflected in a stock's ticker symbol. This economic foundation is the bedrock upon which all successful investment strategies are built. Chapter 5: The Structure of the Capital Markets. To the uninitiated, the Canadian capital market often resembles a chaotic storm of flashing tickers and incomprehensible jargon. Yet, beneath the surface of every trade lies a sophisticated and highly structured ecosystem designed to move money from those who have it to those who need it. At its heart, This system is the lifeblood of the Canadian economy, providing the necessary grease for the wheels of industry to turn. Whether it is a tech startup in Waterloo looking for venture seed money or a provincial government issuing bonds to fund a new transit line, the capital market is the central arena where dreams of expansion meet the cold, hard reality of fiscal investment. The journey of any security begins in the primary market. This is the new car dealership of the financial world, where issuers, governments, and corporations sell brand new stocks and bonds directly to investors for the first time. For a student of the CSC, understanding this phase is crucial because it represents the actual moment of capital creation. It is here that investment dealers act as the vital bridge, serving as underwriters who navigate the legal complexities of a prospectus and risk their own capital to ensure a successful launch. When you hear about an initial public offering, IPO, you are witnessing the primary market in its most public and dramatic form. Once those securities have been issued and the initial capital has been raised, they move into the secondary market. If the primary market is the dealership, the secondary market is the vast global exchange where pre-owned securities are traded among investors. Here, the original issuer is no longer a party to the transaction. Instead, buyers and sellers trade with one another through stock exchanges or over-the-counter markets. This environment provides the liquidity that makes the entire system viable. After all, few investors would be willing to lock their money into a long-term bond or stock if they didn't have the confidence that they could sell it for cash at a fair market price the very next day. Central to this entire structure are the investment dealers, the orchestrators of the Canadian financial landscape. These firms wear multiple hats. They act as principals, taking on the risk of holding securities in their own inventory, and as agents, executing trades on behalf of clients for a commission. By maintaining an orderly market and providing expert research, these participants ensure that the flow of capital remains fluid and transparent. As you master the nuances of these market roles, you begin to see the Canadian Securities Course not just as a collection of rules, but as a map to the engines of national prosperity. Chapter 6: Introduction to Investment Products. The world of investing often feels like a sprawling marketplace, bustling with complex jargon and competing promises. However, at its core, the entire financial ecosystem rests on a simple, fundamental exchange. Organizations need capital to grow, and investors provide that capital in exchange for a potential return. This chapter serves as your gateway to the primary vehicles used to facilitate this exchange. By understanding the distinction between equity and debt, you begin to see the architecture of the Canadian financial markets, not as a confusing maze, but as a structured toolkit designed to manage risk and reward. When you step into the world of equity, you are transitioning from a spectator to a part owner. Common shares represent the most basic form of corporate ownership, offering the potential for capital appreciation and a voice in corporate governance through voting rights. However, this upside comes with the highest degree of risk. If a company falters, common shareholders are the last in line to receive any remaining assets. Preferred shares occupy a unique middle ground, often behaving like a hybrid between a stock and a bond. They provide a more stable stream of income through fixed dividends and grant investors a higher claim on assets than common shareholders, albeit usually at the cost of voting power and significant growth potential. On the other side of the ledger lies the world of fixed income securities, where the relationship is defined not by ownership, but by a loan. When you purchase a bond or a debenture, you are essentially acting as the bank. You lend your capital to a government or corporation for a set period in exchange for regular interest payments and the promise that your original investment will be returned upon maturity. The critical distinction here lies in security. Bonds are typically backed by specific physical assets as collateral, while debentures rely solely on the full faith and credit and general reputation of the issuer. Mastering the terminology of these asset classes is the bridge between theoretical knowledge and practical application on the CSC exam. It is not enough to simply know what a share or a bond is. You must understand the hierarchy of claims, the nature of the income they generate, and how each instrument fits into a diversified portfolio. As we peel back the layers of these investment products, you will gain the clarity needed to evaluate which instruments serve a client's need for safety and which are better suited for the pursuit of aggressive growth. Chapter 7: Fixed Income Securities, Pricing and Features. At the heart of the fixed income market lies a fundamental paradox that every successful investor must respect. When interest rates climb, bond prices fall, and when rates tumble, prices soar. This inverse relationship is not merely a market quirk. It is a mathematical certainty governed by the seesaw effect. To master the Canadian Securities Course, you must move beyond simply memorizing this rule and begin to understand the mechanics behind it. A bond is, in its purest form, a promise of future cash flows, and the price an investor is willing to pay today depends entirely on how those future payments stack up against the prevailing rates offered by the rest of the world. Pricing a bond requires an appreciation for the time value of money, where the present value of all expected future interest payments, the coupons, and the final return of principal are discounted back to the current day. This calculation is where the yield to maturity takes center stage. Unlike the simple coupon rate printed on a bond certificate, the yield to maturity provides a holistic view of the total return. It accounts for the capital gain or loss that occurs when you buy a bond at a discount or a premium and hold it until the day it matures. Understanding this distinction is the difference between an amateur observer and a professional analyst. Risk in the fixed income world is often measured by a single, powerful metric: duration. While many newcomers confuse duration with a bond's term to maturity, it is actually a measure of sensitivity. It tells you exactly how much a bond's price will swing in response to a 1% change in interest rates. A long-term provincial bond with a low coupon is a high-duration instrument, twitching violently with every central bank announcement, while a short-term corporate note may barely budge. By mastering duration, you learn to quantify the volatility of a portfolio, allowing you to shield your capital from the erosive effects of rising rates. As you navigate this chapter, view these formulas not as hurdles, but as the tools of the trade. Whether you are calculating the current yield or analyzing the impact of a shift in the yield curve, you are learning to read the pulse of the global economy. Fixed income securities are the bedrock of the financial system, providing the stability and income that keep the markets moving. By the end of this section, the complex interplay between price, yield, and time will no longer be a source of confusion, but a strategic map you can use to navigate the Canadian financial landscape. Chapter 8: The Fixed Income Market and Trading Techniques. In the sophisticated architecture of the Canadian financial system, the fixed income market serves as the bedrock upon which institutional stability is built. While equity markets often garner the headlines with their volatile swings and high-stakes drama, the debt market operates with a quieter, more calculated precision. To master the Canadian Securities Course, one must transition from simply understanding what a bond is to evaluating the diverse landscape of issuers, from the sovereign strength of the Government of Canada to the strategic leverage of major corporations. Each offering carries a specific promise of repayment, yet the certainty of that promise varies significantly depending on whose name is printed on the certificate. Government debt in Canada is categorized by a distinct hierarchy of risk and liquidity. At the summit are Government of Canada bonds, often considered the gold standard or risk-free benchmark against which all other domestic debt is measured. These high-quality instruments provide the essential plumbing for the country's economy. Moving down the ladder, provincial and municipal bonds offer slightly higher yields to compensate for the varying fiscal health of different regions. Evaluating these securities requires a keen eye for spreads, the incremental yield difference over federal benchmarks, and an understanding of how regional economic drivers, such as natural resources in the West or manufacturing in the East, influence a province's ability to service its debt. The corporate sector introduces a more complex layer of analysis, where the risk of default moves from a theoretical abstraction to a tangible possibility. When a corporation issues debt, they are inviting you to become a creditor to their business strategy, and your primary defense as an investor is the credit rating. Agencies like DBRS Morningstar, Moody's, and S&P provide the essential shorthand for a bond's quality, ranging from the fortress-like security of investment grade to the speculative volatility of high-yield or junk bonds. As a student of the CSC, you must learn to look past the coupon rate and scrutinize the underlying credit risk, recognizing that a higher yield is never a free lunch. It is a mathematical reflection of the uncertainty surrounding the issuer's future cash flows. Trading these instruments requires a departure from the centralized exchange model typical of stocks. The fixed income market is primarily an over-the-counter OTC environment, where liquidity is driven by a network of dealers and market makers. Success in this arena demands an understanding of how bonds are priced in decimals, how accrued interest affects the final cost of a trade, and how the inverse relationship between interest rates and bond prices dictates market movement. By the end of this chapter, you will not only be able to identify different types of debt offerings, but also evaluate their place within a diversified portfolio, balancing the need for steady income against the ever-present risks of inflation, interest rate shifts, and credit downgrades. Chapter 9: Equity Securities, Common and Preferred Shares. To own equity is to move from the sidelines of the economy into the owner's box. While fixed income instruments like bonds represent a contractual obligation, a promise to be paid back with interest, equity represents a stake in the very soul of a corporation. When you purchase common shares, you aren't just lending money, you are buying a piece of a company's future potential, its intellectual property, and its physical assets. This transition from creditor to owner is the fundamental engine of wealth creation in the Canadian financial markets, offering an invitation to participate in the growth of iconic national brands and global innovators alike. The primary allure of common shares lies in their residual claim on the company's success. As a common shareholder, you stand last in line behind the taxmen, the employees, and the bondholders, but this position of risk is exactly what creates the opportunity for unlimited upside. Unlike debt, which has a capped return, common equity has no ceiling. Through capital appreciation, the simple but powerful act of a stock price rising, and the distribution of profits via dividends, investors can see their initial outlay multiply many times over. It is this unique combination of income and growth that makes equities the cornerstone of any long-term investment strategy designed to outpace inflation. Beyond the financial ledger, equity ownership grants you a voice. Every common share typically represents a vote, giving you the democratic right to participate in the company's governance by electing the board of directors. While a retail investor might only own a fraction of a percentage of a major bank or utility, the collective power of shareholders ensures corporate accountability. This chapter will dissect how these voting rights function and explore why some investors prefer the stability of preferred shares, a hybrid security that offers the regular income of a bond with the tax advantages of equity. Understanding these nuances is not just about passing an exam. It is about mastering the tools that build legacies. Chapter 10: Equity Transactions and Market Operations. The Canadian equity market is a marvel of high-speed synchronization, a digital ecosystem where billions of dollars change hands through a sophisticated invisible architecture. When you press buy or sell on a trading platform, you are participating in a legacy that has evolved from the shouting crowds on physical trading floors to the silent, lightning-fast matching engines of the Toronto Stock Exchange, TSX, and the TSX Venture Exchange. Understanding this environment requires more than just knowing a ticker symbol. It requires a mastery of market operations, the mechanics of how a theoretical price becomes a finalized transaction. At the heart of every trade lies the order type, the primary tool an investor uses to communicate their intent and risk tolerance to the market. The most straightforward of these is the market order, an instruction to buy or sell immediately at the best available current price. While a market order guarantees execution, it does not guarantee price, making it a double-edged sword in volatile conditions. Conversely, the limit order provides the investor with precision and control, specifying the maximum price they are willing to pay or the minimum they are willing to accept. By using limit orders, an investor effectively steps into the role of a liquidity provider, adding their demand to the central limit order book and waiting for the market to come to them. Beyond simple entry and exit, sophisticated market participants utilize stop-loss and stop-buy orders as essential risk management safeguards. A stop-loss order remains dormant in the system until a specific price trigger is hit, at which point it awakens as a market order to protect the investor from further downside. These tools are the guardrails of a trading strategy, ensuring that a lapse in emotional discipline or a sudden market shift doesn't lead to catastrophic capital erosion. In the fast-moving Canadian landscape, where resource stocks and financial giants can pivot on a single news headline, mastering these order types is the difference between controlled investing and reckless gambling. The execution of these orders is governed by the principles of price and time priority. In the Canadian marketplace, the best price always wins, and if two orders share the same price, the one that arrived first takes precedence. This auction-style logic ensures a fair and transparent playing field for all participants, from individual retail investors to massive institutional hedge funds. As you navigate this chapter, you will learn to look past the flashing green and red numbers on your screen and see the underlying machinery of bids, asks, and spreads that keep the Canadian economy in motion. Chapter 11: Introduction to Derivatives and Options. To many investors, the word derivatives conjures images of complex mathematical formulas and high-stakes gambling in the dark corners of Wall Street. However, at its core, a derivative is far less mysterious than its reputation suggests. The name itself reveals its secret. A derivative is simply a financial contract that derives its value from an underlying asset, such as a stock, a bond, a commodity, or even a market index. Like a shadow cast by an object, the derivative moves in relation to the primary asset, providing a unique way for investors to participate in price movements without ever actually owning the asset itself. Think of a derivative as a side bet on the future. While the primary market involves the immediate exchange of cash for ownership, the derivatives market is built on promises and possibilities. If you have ever locked in a fixed mortgage rate or prepaid for a flight months in advance, you have already engaged in the basic logic of these instruments. In the world of the Canadian Securities Course, these tools are categorized into three main pillars: options, forwards, and futures. Each serves as a specialized gear in the machinery of modern finance, allowing market participants to either protect what they have or profit from what they anticipate. The true power of derivatives lies in their versatility, serving two primary and often opposing masters: the hedger and the speculator. For the hedger, derivatives act as a form of insurance, a way to lock in prices and mitigate the dry mouth anxiety of market volatility. A Canadian wheat farmer, for example, might use a futures contract to guarantee a selling price for a crop that hasn't even been harvested yet. On the flip side, the speculator uses the same tools as a lever. By putting down a relatively small amount of capital to control a much larger position, they seek to magnify their gains, embracing the very risk that the hedger is trying to avoid. As you navigate this chapter, we will peel back the technical jargon to look at the mechanics of these contracts. We will explore how a call option gives you the right to buy, how a put option gives you the right to sell, and how forward and futures contracts obligate parties to act at a later date. Demystifying these products is not just about passing an exam. It is about understanding the sophisticated tools used to manage the ebbs and flows of global capital. By the end of this discussion, what once seemed like an intimidating labyrinth of numbers will become a clear and logical landscape of strategic opportunity. Chapter 12: Rights, Warrants, and Convertible Securities. In the sophisticated landscape of corporate finance, a company's capital structure is rarely a static balance sheet of simple debt and equity. Instead, it is a living ecosystem that evolves through strategic corporate actions designed to raise capital, reward loyalty, or manage obligations. To the uninitiated, terms like rights and warrants may sound like legal jargon, but to the savvy investor, they represent a unique category of financial instruments known as derivative-like sweeteners. These tools allow companies to tap into the market's liquidity without the immediate burden of high-interest debt, offering investors a specialized pathway to participate in a firm's future growth. For the existing shareholder, the issuance of rights is a call to action rooted in the principle of preemptive privilege. When a corporation decides to issue new common shares, it must often give its current owners the first opportunity to maintain their proportional ownership in the company. This prevents the dilution of their voting power and economic interest. A rights offering is essentially a time-sensitive invitation. An investor is granted the short-term option to purchase additional shares, usually at a discount to the current market price. Understanding the mechanics of these rights, how they are valued, how they trade cum rights versus ex rights, and the consequences of letting them expire worthless is a fundamental skill for any Canadian securities professional. While rights are fleeting and mandatory by design, warrants and convertible securities offer a longer-dated, more strategic horizon for the portfolio. A warrant is often described as a sweetener attached to a new bond or preferred share issue, giving the holder the right to buy common shares at a fixed price years into the future. It is a bet on the company's long-term trajectory. Similarly, convertible securities, such as convertible debentures, bridge the gap between the relative safety of fixed income and the explosive potential of the upside. They provide the steady pulse of interest payments with a trapdoor option to flip the investment into common equity if the stock price soars. Navigating these instruments requires more than just memorizing definitions. It requires an analytical eye for how these actions influence security prices and market perception. When a company announces a rights offering or an influx of warrants is exercised, the sudden shift in the number of outstanding shares can send ripples through the trading floor. For the CSC candidate, mastering Chapter 12 means learning to calculate the intrinsic value of these opportunities and recognizing when a corporate action is a sign of financial distress or a bold leap toward expansion. By the end of this journey, you will view these specialized securities not as complexities to be feared, but as powerful levers for wealth creation. Chapter 13. Mutual funds. Structure and regulation. The mutual fund remains the cornerstone of the Canadian retail investment landscape, offering a bridge between the modest saver and the sophisticated world of capital markets. At its core, a mutual fund is a vehicle for collective investment, a pool of capital gathered from thousands of individual investors and entrusted to a professional fund manager. For many, the primary allure lies in this democratization of finance. It allows a person with a few $100s to achieve the same level of professional oversight and asset diversification once reserved for high net worth institutional clients. Instead of managing a complex portfolio of individual stocks or bonds, the investor holds units of a larger whole, enjoying the mitigation of risk through variety and the peace of mind that comes with full-time management. Understanding how a mutual fund operates requires looking under the hood at its legal and operational architecture. In Canada, mutual funds are typically structured as either open-end trusts or investment corporations. The trust structure is the most prevalent, governed by a trust deed that establishes the fund's objectives and the relationship between the trustee, the manager, and the unit holders. Unlike shares of a public company on the TSX, which trade based on supply and demand throughout the day, mutual fund units are purchased and redeemed based on their net asset value per share, NAPS. This figure is the fundamental heartbeat of the fund, calculated by subtracting the fund's liabilities from its total assets and dividing by the number of units outstanding. It represents the fair market price of a single piece of the pie, typically determined at the close of every business day. While the benefits of professional management are clear, they are not without cost, and navigating the landscape of sales charges is a vital skill for any advisor. Whether an investor encounters a front-end load, a deferred sales charge, DSC, or a low-load option, these fees influence the net return and the suitability of the investment. Beyond the mechanical costs of buying and selling, the fund must also operate within a rigorous regulatory framework designed to ensure transparency and protect the public interest. From the simplified prospectus to the fund facts document, the regulatory environment in Canada is built on the principle of full, true, and plain disclosure. Mastering these structural nuances is not just about passing an exam. It is about understanding how to build a transparent, cost-effective foundation for a client's financial future. Chapter 14, Mutual Funds, Strategies and Performance Evaluation. At the heart of the Canadian financial landscape lies the mutual fund, a versatile vehicle designed to democratize investing by pooling capital into professionally managed portfolios. However, the sheer variety of available mandates can be dizzying for the uninitiated. To master this landscape, one must look past the marketing brochures and categorize funds by their underlying DNA, the asset class. Whether an investor is seeking the ironclad stability of a money market fund or the aggressive growth potential of a small-cap equity fund, the suitability of the choice hinges entirely on the alignment between the fund's objective and the client's risk tolerance. For the conservative investor, the journey often begins with money market and fixed income funds. Money market funds act as the bedrock of liquidity, investing in high-quality, short-term debt instruments like treasury bills and commercial paper to provide a parking spot for cash with minimal risk to principal. Moving up the risk-reward spectrum, bond funds offer a steady stream of interest income and the potential for capital appreciation as interest rates fluctuate. Here, the CSC student must distinguish between government, corporate, and high-yield mandates, recognizing that while these funds provide a buffer against stock market volatility, they remain sensitive to the relentless ebbs and flows of the credit cycle. Equity funds represent the engine room of long-term wealth creation, yet they are far from a monolithic category. They range from the relative safety of blue-chip dividend funds to the high-octane environment of aggressive growth funds. Beyond the broad domestic markets, specialty and sector funds allow investors to narrow their focus onto specific industries like technology, precious metals, or healthcare. While these concentrated bets offer the chance to outperform the broader index, they also introduce unique, unsystematic risks. Understanding these distinctions is not just about memorizing definitions. It is about developing the professional intuition required to construct a balanced portfolio that can weather any economic season. Chapter 15, Exchange-Traded Funds, ETFs, and Low-Cost Investing. In the landscape of modern Canadian finance, few instruments have reshaped the investment horizon as profoundly as the Exchange-Traded Fund, ETF. Since the launch of the world's first ETF on the Toronto Stock Exchange in 1990, these vehicles have evolved from a niche alternative into a cornerstone of both institutional and retail portfolios. At its core, an ETF offers the best of two worlds: the professional diversification of a mutual fund combined with the real-time liquidity and execution of a common stock. For the CSC student, understanding this evolution is not just about memorizing a product category. It is about grasping a fundamental shift toward transparency and systematic, low-cost wealth accumulation. While ETFs and traditional mutual funds share the same DNA, providing investors with access to a pooled basket of securities, their operational mechanics are worlds apart. Mutual funds are typically priced only once per day at their net asset value after the markets close, often leaving investors in the dark regarding their exact execution price. ETFs, conversely, are traded on an exchange throughout the day, allowing for limit orders, short selling, and the use of margin. This intraday flexibility is supported by an in-kind creation and redemption process, a sophisticated behind-the-scenes mechanism that keeps the ETF's market price closely aligned with its underlying value, while significantly reducing the drag of transaction costs. Beyond liquidity, the primary allure of the ETF lies in its tax efficiency and cost structure. Because most ETFs are designed to track a specific index, they experience much lower turnover than actively managed mutual funds. This passive approach doesn't just result in lower management expense ratios, MERs, it also triggers fewer capital gains distributions, allowing the investor's capital to compound more effectively over time. As you navigate the complexities of the Canadian Securities Course, viewing ETFs through the lens of cost-to-performance ratio will reveal why they have become the preferred tool for the modern, fee-conscious advisor. Chapter 16, Alternative Investments and Structured Products. In the rarefied air of high-net-worth investing, The traditional balanced portfolio of blue-chip stocks and government bonds often feels like a crowded room. For the investor who has maximized conventional growth, the horizon shifts toward the world of alternative investments, a landscape where exclusivity meets complexity. These are not the liquid, transparent assets found on a ticker tape during the nightly news. Instead, they are the sophisticated machinery of the financial elite. Hedge funds that bet on market volatility, private equity firms that rebuild entire industries, and structured products designed with surgical precision to manage risk. To enter this arena, one must first pass through the gate of the accredited investor designation. This is more than just a regulatory label. It is a legal acknowledgement of financial sophistication and the capacity to weather significant loss. The Canadian Securities Administrator sets these thresholds high, under the assumption that those with substantial assets or income possess the professional advice and the capital cushion necessary to navigate markets where transparency is lower and liquidity is often restricted. In the world of alternatives, you are no longer just a participant in the market. You are often a partner in a long-term private venture where your capital may be locked away for years in exchange for the promise of alpha. Structured products, such as principal protected notes, PPNs, offer a different kind of allure by blending the safety of fixed income with the upside potential of equities. They represent the engineering side of finance, where underlying derivatives are packaged into a single instrument tailored to specific market views. However, this customization comes with a trade-off. While a PPN might offer a safety net for your initial investment, it introduces credit risk and a lack of secondary market liquidity that the average retail investor might find stifling. Understanding these vehicles requires peeling back the layers of fees and performance hurdles to see what truly drives the returns. Ultimately, Chapter 16 is about the transition from following the market to seeking out performance through diversification in its truest form. While the risks are undeniably higher, ranging from the leverage used by hedge fund managers to the illiquidity of a private equity buyout, the strategic inclusion of these assets can provide a non-correlated edge that traditional portfolios simply cannot match. For the advisor, mastering these products is about more than just understanding the math. It is about knowing how to vet the managers who operate in the shadows of the public markets and ensuring that the pursuit of higher returns never compromises the client's fundamental financial security. Chapter 17, Fundamental Analysis and Financial Statements. To the uninitiated, a company's annual report can feel like a labyrinth of dense jargon and intimidating columns of figures. However, for the serious investor, these documents are the closest thing to a corporate medical exam. Fundamental analysis is the art of peering beneath the surface of stock tickers and market hype to assess a business's true intrinsic value. It begins with the understanding that behind every three-letter symbol on the exchange is a living, breathing entity with assets, liabilities, and a history of profit or loss. Mastering this chapter means learning to strip away the narrative and focus on the hard data that determines whether a company is a solid fortress or a house of cards. The balance sheet serves as a financial snapshot, freezing a single moment in time to show exactly what a company owns and what it owes. It follows the most sacred equation in accounting: assets equals liabilities plus shareholders' equity. By examining the current ratio, flipping the perspective to see if short-term assets can cover immediate debts, you begin to gauge a firm's liquidity and its ability to weather a sudden economic storm. Meanwhile, the debt-to-equity ratio reveals the company's capital structure, acting as a barometer for financial risk. Is the business fueled by sustainable growth, or is it drowning in borrowed capital? The balance sheet provides the answer. If the balance sheet is a snapshot, the income statement is a motion picture, detailing the flow of money over a specific period. This is where you witness the transformation of raw revenue into the bottom line. By analyzing this statement, you can calculate the most watched metric in the financial world: net income. From here, fundamental analysis takes flight with the price-to-earnings (PE) ratio, a vital tool that helps you determine if you are paying a fair price for a slice of the company's profits. By the end of this journey through the financials, you will no longer be guessing based on market whispers. you will be making informed decisions rooted in the cold, hard reality of a company's performance. Chapter 18: Technical Analysis and Market Timing. If fundamental analysis is the study of what an asset is worth, technical analysis is the study of what the market thinks it is worth. While a fundamental analyst pores over balance sheets and cash flow statements to find intrinsic value, the technician looks at the tape. To the technical analyst, the company's quarterly earnings and debt-to-equity ratios are secondary. They believe that all relevant information is already baked into the stock price. This methodology rests on the bedrock principle that price action moves in trends, and that history, driven by the unchanging facets of human psychology, has a persistent habit of repeating itself. Understanding this discipline requires a shift in perspective from accounting to geometry. At the heart of chart analysis are the concepts of support and resistance, the invisible floors and ceilings that define a security's trading range. Support represents the price level where buying interest is strong enough to overcome selling pressure, halting a decline. Conversely, resistance is the point where selling pressure mounts, capping an advance. Mastering these levels allows a trader to identify the path of least resistance, turning a chaotic collection of price points into a map of market sentiment. To smooth out the daily noise of the market, technicians rely on moving averages. These trend-following indicators calculate the average price of a security over a specific number of periods, providing a clearer picture of whether a trend is gaining momentum or beginning to roll over. When paired with sentiment indicators, which measure the prevailing mood of investors from extreme optimism to deep-seated fear, these tools form a comprehensive toolkit for market timing. In the context of the Canadian Securities Course, your goal is not just to memorize these patterns, but to understand the tug-of-war between supply and demand that they represent. Ultimately, technical analysis is a study of behavior. Every bar on a candlestick chart and every spike in trading volume is a footprint left by a collective group of investors. By learning to read these footprints, you move beyond the why of market movements and start focusing on the when. As you progress through this chapter, keep in mind that these tools are not crystal balls. Rather, they are instruments of probability designed to help you identify high-conviction entry and exit points in an inherently uncertain environment. Chapter 19: The Portfolio Management Process. Investing is often mistaken for a game of picking winners, but the true craft lies not in the individual selection, but in the architecture of the whole. Portfolio management is the transition from a collection of isolated bets to a cohesive financial engine designed to withstand the unpredictability of the markets. It is the process of synthesizing investor objectives with market realities, ensuring that every asset serves a distinct purpose. Rather than focusing on a singular hot tip, the disciplined advisor looks at the horizon, mapping out a strategy where the strengths of one security offset the vulnerabilities of another. At the heart of this structural design is the principle of asset allocation, the primary determinant of an investor's long-term success. By distributing capital across various asset classes, equities for growth, fixed income for stability, and cash equivalents for liquidity, you create a foundation that balances the pursuit of return against the necessity of preservation. This is where the theoretical meets the practical. It is where we determine the exact proportions that align with a client's unique risk tolerance and time horizon. Diversification acts as the only free lunch in finance, allowing us to mitigate unsystematic risk and smooth out the volatility that often leads to emotional and often costly decision-making. The portfolio management process is a continuous cycle of planning, execution, and feedback. It begins with the Investment Policy Statement, IPS, a roadmap that dictates how wealth will be managed through both bull and bear markets. Once the initial blueprint is set and the capital is deployed, the work shifts toward monitoring and rebalancing. As markets shift, the original proportions of a portfolio will inevitably drift, requiring the steady hand of a manager to sell high in overperforming sectors and buy into undervalued areas. This chapter will guide you through this rigorous framework, providing the tools to build portfolios that don't just survive market cycles, but thrive within them. Chapter 20: Taxation. The impact on investment returns. In the world of investing, it is not what you earn that determines your financial success, but what you keep. For the Canadian investor, the taxman is a silent partner in every transaction, standing ready to claim a portion of the harvest. Navigating the complex terrain of the Income Tax Act is often the difference between a portfolio that merely grows and one that truly thrives. As you prepare for the CSC, understanding the hierarchy of taxation is paramount. Not all investment income is created equal in the eyes of the Canada Revenue Agency. Whether you are collecting steady interest from a bond, receiving dividends from a blue-chip corporation, or realizing a windfall from the sale of an asset, the tax implications will profoundly reshape your real rate of return. The journey begins with distinguishing between the three primary pillars of investment income: interest, dividends, and capital gains. Interest income is the most straightforward, yet the most heavily taxed, as it is treated as ordinary income and taxed at your full marginal rate. Dividends from Canadian corporations offer a more favorable path, thanks to the dividend tax credit, which accounts for taxes already paid at the corporate level. However, for many, the holy grail of tax efficiency is the capital gain. Because only 50% of a capital gain is included in your taxable income, it remains one of the most powerful tools for building long-term wealth. Mastering these distinctions is the first step in moving beyond simple stock picking and toward true portfolio management. To accurately report these gains, you must master the mechanics of the Adjusted Cost Base, ACB. This is more than just a bookkeeping exercise. It is the fundamental calculation that prevents you from being taxed twice on the same dollar. The ACB accounts for the original purchase price of an investment, plus any additional costs incurred, such as brokerage commissions or reinvested dividends. In a landscape of frequent trading or systematic reinvestment plans, these numbers can become a tangled web. Learning to calculate the ACB with precision ensures that when you finally exit a position, you are only paying the tax you truly owe, protecting your hard-earned principal from unnecessary erosion. Ultimately, tax-efficient investing is about strategy and location. By understanding which assets belong in registered accounts like the RRSP or TFSA and which are better suited for non-registered accounts, you can shield your returns from the friction of annual taxation. The goal of this chapter is to equip you with the technical proficiency to calculate tax liabilities and the strategic foresight to minimize them. As you master these concepts, you will stop seeing taxes as an unavoidable burden and begin seeing them as a variable that can be managed, optimized, and conquered on the path to financial mastery. Chapter 21: Registered Plans and Retirement Savings. The Canadian financial landscape is defined by its alphabet soup of tax-advantaged accounts, but beneath the jargon of RRSPs, TFSAs, and RSPs lies the engine of long-term wealth creation. These registered plans are not merely accounts. They are strategic shelters designed by the government to incentivize specific behaviors: saving for retirement, building an emergency fund, or funding a child's education. For the candidate tackling the CSC, understanding these vehicles is more than an academic exercise in memorizing contribution limits. It is about mastering the mechanics of tax deferral and tax-free growth, the two most potent forces in a retail investor's arsenal. The Registered Retirement Savings Plan, RRSP, remains the cornerstone of Canadian retirement planning, rooted in the elegant principle of tax deferral. By allowing individuals to deduct contributions from their earned income, the RRSP effectively provides an immediate tax refund, grounded in the assumption that the contributor is currently in a higher tax bracket than they will be during their golden years. However, mastery of the RRSP requires a nuanced understanding of the earned income calculation and the mechanics of the deduction limit. It is a balancing act of timing, knowing when to claim a deduction to maximize its impact, and understanding the consequences of the eventual deregistration that turns every penny withdrawn into taxable income. In stark contrast to the RRSP's tax-later approach stands the Tax-Free Savings Account, TFSA, perhaps the most flexible and misunderstood tool in the Canadian investor's kit. Unlike the RRSP, the TFSA offers no upfront tax break, but it provides something arguably more valuable: total immunity from taxation on capital gains dividends, and interest earned within the plan. For the CSC student, the complexity of the TFSA lies in the rules surrounding recontribution. Navigating the pitfalls of overcontribution and the timing of withdrawals is essential, as these accounts serve as both a high liquidity safety net and a high growth vehicle for long-term compounding. Finally, the Registered Education Savings Plan introduces a unique third dimension to tax-advantaged investing, the government grant. Through the Canada Education Savings Grant, CESG, the federal government provides a direct incentive for parents to save, matching a percentage of contributions up to a lifetime limit. While the tax on the growth is eventually paid by the student, who typically resides in the lowest possible tax bracket, the true power of the RESP lies in this fusion of private investment and public subsidy. To master this section of the curriculum, one must grasp the distribution rules between educational assistance payments and the original capital, ensuring that the heavy lifting of tuition is supported by the most tax-efficient withdrawal strategy possible. Chapter 22: Financial Planning and Individual Life Cycles. Investment management is never a one-size-fits-all endeavor. It is an exercise in precision mapping. To guide a client toward their financial destination, you must first understand exactly where they stand in the grand progression of the human life cycle. A 24-year-old entering the workforce with decades of earning potential ahead requires a radically different strategy than a retiree prioritizing capital preservation and consistent cash flow. As an advisor, your task is to translate these biological milestones into financial frameworks, identifying whether the client is in the accumulation, consolidation, or decumulation phase of their journey. At the heart of this alignment lies the Investment Policy Statement, IPS, the foundational document that serves as the constitution of the client-advisor relationship. The IPS is more than just a list of stocks or bonds. It is a formal blueprint that marries a client's long-term objectives with their immediate constraints. By clearly defining return requirements, liquidity needs, time horizons, and tax considerations, the IPS provides a disciplined roadmap that prevents emotional decision-making when market volatility inevitably strikes. It ensures that every investment product chosen serves a specific purpose in the context of the client's broader life goals. However, the technical mechanics of an IPS are only as effective as your assessment of the client's risk profile. Determining risk tolerance is as much an art as it is a science, requiring you to distinguish between a client's ability to take risk and their willingness to do so. While a high net worth individual may have the financial cushion to withstand a market downturn, they may lack the psychological temperament to see their portfolio value fluctuate. Mastering this chapter means learning how to bridge that gap, balancing the clinical realities of the life cycle with the human realities of investor psychology to build portfolios that are both robust and sustainable. Chapter 23: Exam Strategy: Preparing for CSC Checkpoint 1 and 2. The Canadian Securities Course is a marathon, not a sprint, and your success depends as much on your tactical approach as it does on your grasp of yield curves or equity valuation. The transition from study to execution begins with acknowledging the unique two-chapter structure of the CSC. Volume 1 and Volume 2 are distinct animals. While the first half demands a rigorous understanding of the economic landscape and the mechanics of fixed income, the second half pivots into the nuanced world of taxation, portfolio management, and the practicalities of the advisor-client relationship. To conquer both, you must abandon the habit of rote memorization in favor of conceptual mastery. The exams are designed to test your ability to apply theory to real-world scenarios, meaning the why behind a financial regulation is often more important than simply knowing the regulation itself. One of the most common pitfalls for candidates is falling into the trap of the plausible within the multiple choice format. The CSI is notorious for crafting distractors that look perfectly reasonable to a student who has only skimmed the material. To combat this, adopt a proactive reading strategy. Cover the options with your hand, read the stem of the question, and formulate your own answer before looking at the choices provided. This prevents the psychological phenomenon of being led to an incorrect but professional-sounding answer. Furthermore, pay close attention to absolute qualifiers, words like always, never, or must, which are frequent red flags in a world as full of exceptions as the Canadian financial markets. Time management is the silent killer of many promising exam attempts. Students often get bogged down in complex margin call calculations or intricate tax bracket scenarios, sacrificing precious minutes that should be spent on higher-yield conceptual questions. Treat the exam like a financial portfolio. Diversify your time. If a question requires more than 2 minutes of your focus, flag it, move forward, and secure the easy marks first. Building a consistent study schedule that mimics the 2-hour exam window will help build your mental stamina. By the time you sit for checkpoint 1 or 2, the format should feel second nature, allowing your brain to focus entirely on the content rather than the ticking clock. Chapter 24: Practice Questions and Case Study Analysis. Theoretical knowledge is a powerful tool, but in the fast-paced environment of a proctored exam, it is the ability to apply that knowledge under pressure that separates a passing grade from a failing one. You have spent hours dissecting the mechanics of equity markets, the tax implications of registered accounts, and the complexities of debt instruments. Now, the focus shifts from passive absorption to active execution. This chapter serves as your final staging ground, a controlled environment where you can stress test your understanding of the Canadian Securities Course material against the same logic and phrasing used on the official exam. The following practice questions have been curated to mirror the structure and difficulty of the actual test, targeting the high-weight areas that often determine a candidate's success. As you work through these scenarios, resist the urge to glance at the answer key prematurely. Treat this as a diagnostic tool. If you find yourself hesitant on questions regarding margin requirements or the nuances of the primary market versus the secondary market, take it as a clear signal that those sections require one final review. Identifying a blind spot now is a minor setback. Identifying it during the exam is a costly oversight. Beyond isolated multiple-choice questions, the case study analysis included here demands a higher level of synthesis. You will be presented with comprehensive financial profiles of hypothetical clients, individuals with specific risk tolerances, time horizons, and tax considerations. Your task is to recommend appropriate investment products and strategies while navigating the regulatory constraints and ethical standards discussed in earlier chapters. This is where the curriculum truly comes to life, transitioning from abstract definitions to the practical, real-world advice that defines a successful professional in the Canadian financial services industry. Efficiency is just as critical as accuracy. Pay close attention to the clock as you progress, training your brain to parse through distractor options and identify the most technically correct answer within the allotted time. Each mistake made in these pages is an invaluable lesson learned in a risk-free environment. Approach these questions with the confidence of someone who has mastered the curriculum, but with the discipline of a student who knows that the final exam is won in the details. Chapter 25, Beyond the Exam, Launching Your Finance Career. The ink on your completion certificate represents more than just a passing grade. It is the official handshake that welcomes you into the inner circle of the Canadian financial services industry. However, it is vital to understand that the CSC is a foundational credential, not a terminal one. In the eyes of regulators and compliance officers, passing the exam makes you registrable, but you are not yet registered. The transition from student to professional begins with the licensing process, typically through the New Entrant Course or the Conduct and Practices Handbook, CPH. This is where the theoretical knowledge of debt markets and equity valuations meets the rigid, necessary framework of ethics and provincial regulation. Once you have the academic requirements under your belt, the focus shifts toward finding a home, selecting a firm that aligns with your professional philosophy. Whether you aspire to the high-stakes environment of an investment bank, the relationship-driven world of retail wealth management, or the analytical depths of a credit union, your first firm will be your crucible. During this phase, your CSC designation serves as your most potent networking tool. It signals to hiring managers that you possess the grit to navigate nearly 1,000 pages of technical material and the discipline to master the Canadian regulatory landscape. When interviewing, don't just highlight your score. Discuss how your understanding of technical analysis or capital structures will add immediate value to their book of business. Landing the job, however, is merely the end of the beginning. The most successful professionals in the Canadian landscape treat the CSC as the first step in a career-long ladder of specialized designations. Depending on your chosen path, your next milestone might be the Chartered Financial Analyst, CFA, Charter for those drawn to portfolio management, or the Certified Financial Planner, CFP designation for those who wish to guide families through their life stages. The finance industry is a living organism, shaped by shifting interest rates, evolving tax laws, and new fintech disruptions. By maintaining a commitment to continuing education, you ensure that your expertise remains as current as the closing bell, transforming a simple certification into a lifelong trajectory of influence and wealth creation.